Hello and welcome. I'm on page 119 of your course pack. In this lecture video, I'm going to talk about specific identification and first in and first out, and also give an overview of inventory costing methods, okay? So I'm just going to pause the lecture video for a second, and then I'm going to show you a different document, one that I've created that's not in your course pack, that kind of explains the importance of why we need to talk about the proper way to cost inventory, okay? So hold on. Okay, so I'm back. So this is an inventory costing illustration using the idea of markers, okay? And that we're a small retail store. So say we just own a small crafting store, okay? A retail store, and we sell crafting supplies or school supplies right over here. And those school supplies include markers. You know, my daughter goes to, well, she's going to start junior high school, which I can't believe. And so she's always in the past had to get markers. I don't know if she'll need that for junior high, but in the past for elementary school, she always had to get markers all the time. Go get markers and all kind of glue and pencils and all those fun things. Okay. So we'd go to Target or Michael's or wherever you want to go buy a lot of school supplies. And so that's what we're dealing with here. And so what happened, let's look at this situation, is let's say that on November 1st, we are the small store that sells markers and other school supplies. We purchase 1,000 boxes of markers at $1 per box from our supplier. So we buy these boxes of markers, 1,000 boxes of markers from our supplier. And each box costs us $1. 10 days later, we buy them from a different supplier, and that supplier charges us for the same box of markers $1.50. Okay? And then on the 15th, we purchase another 1,000 boxes of markers from a different supplier, and then they charge us $2. All right? These are all the same markers, It's just that we had to buy them from different suppliers. Maybe supplier one just ran out of stock, and then this supplier ran out of stock, so we had to go to the third supplier. Okay? So run on markers. So on the 15th, let's assume that we have 3,000 boxes of markers, but the thing is they were purchased at different costs. 1,000 boxes were purchased at $2. 1,000 boxes were purchased at $1.50. 1,000 boxes were purchased at $1. Okay? So on 11/19, let's say that we sell one box of markers. What is the cost of the one box of markers? Well, okay, here's the problem. We have 3,000 boxes of markers. Which one did we sell? The one that we bought for $2? The one that we bought for $1.50, or the one that we bought for $1? These are all on the shelf. We don't know. We don't have labels on them saying, hey, we bought this one for $1, we bought this one for $1.50. And the barcode doesn't tell us that. The barcode, you know, when you go up and you get it scanned at the cashier, the barcode doesn't say this box of markers, which is purchased from the supplier for $1.50 or $2 or $1. It doesn't say that. It says it's a box of markers. Okay? So how can we figure out what our cost of goods sold is? Because we know that when we have a perpetual inventory accounting system, right? Let's say we sold this box of markers for cash. Let's say that we sold it for $3. Okay, we sold it for $3. So we debit cash, we credit sales for $3, and then we have to debit cost of goods sold and credit merchandise inventory. We know that from chapter 5. But for how much? How much? $2? $1.50? Or $1? I don't know. It's hard to say, right? You have 3,000 boxes of markers that you're trying to keep track of. You can't keep track. You can't put that level of detail in the information system yet to track that for 3,000 boxes of markers. And to say out of all those 3,000, we know it's either the $1, the $1.50, or the $2. We don't know. We know we have to debit cost of goods sold and credit merchandise inventory. We just don't know for how much. Okay? So we have to make certain assumptions. in order to get around some limitations in the information system, we have to make a few assumptions, okay, about which box of markers maybe we sold. The $1, the $1.50, or the $2. And then we also have to make some assumptions because that will then, which one did we sell? The $1, the $1.50, or the $2? That also comes into play about how we calculate the value of our leftover inventory. Our 2,999 boxes that we haven't sold yet. What's the value of that inventory? Well, it depends upon which ones you sold, right? Depends upon which ones you sold. So there's a few assumptions that we can make. The first one we'll talk about is first in, first out. Okay? What this says is that the cost of the box of markers is $1. Okay, this would be the cost of goods sold. So we debit cost of goods sold, credit merchandise inventory for $1. First in, first out. So what that's saying, the first one that we got in was the $1. And then what we assume is that's the first one that we sold. The first one that we bought is the first one that we sold. That's first in, first out. So that's one assumption. The second assumption that we could make is last in, first out. So the most recent or the most recent purchase, that's the one that we sold first. In that case, right, cost of goods sold is $2. Debit cost of goods sold, credit merchandise inventory, $2. The other thing that we could do is we could say, well, these are all boxes of markers and they're all pretty similar. So maybe we could just take a weighted average. We could take a weighted average. We could do that. So how could we do that? We could take our 1,000 box markers times the $1. There's the cost. There's the cost. And then we could just add it up and divide by 3,000. And we get $1.50. And then that's the weighted average. Or then the other way that we could do it is specific identification. Now what this means, though, is that we have to have a very sophisticated information system. And most companies don't quite have this level of technology at a reasonable cost. You can always you can probably get the technology, but it's going to be really expensive. And so the companies just say it's not worth it, right? But with specific identification, what we could do is somehow tag each box of markers that we buy and then say, in that tag, we say we bought this one for $1, we bought this one for $1.50, we bought this one for $2. And when you go up to the cashier and it scans, it registers as the cost that you bought it for was $1 or $1.50 or $2. And that's where I'm saying the technology isn't quite there yet at a reasonable cost. Barcodes don't provide you that level of detail. Okay? RFID tags do, but RFID tags are still expensive. Okay? And it would be cost prohibitive at that level of detail. All right? So the problem is, again, getting back to the central problem, which box of markers did you sell? If we can't do specific identification, right, that would be the ideal. But if we can't do that, we have to do some other assumptions. We can either do FIFO, LIFO, weighted average, or if we could somehow do this, right, but specific identification probably is not a good option for high volume sales like markers. Maybe for a car dealership, that's a good option. Okay? Because the car dealership, they know the exact car that they sold. They don't sell that many cars a day, right? So they can keep track and say, this is the exact car that we sold because we can track it by the VIN number. Okay? So you kind of get the idea of the problem that we have to make certain assumptions to get around limitations of the information system, right? We either have to say first in, first out, last in, first out, weighted average. Or we could assume specific identification if we can do this, okay? If we have the technology to do this. Now, why do we even need to do this? Well, your old friend, the matching principle, right? Getting back to some of those principles that we talked about back in Chapter 1 lecture notes. Remember the matching principle, the revenue recognition principle, cost principle, the full disclosure principle. And you remember Professor Henderson saying you need to know these principles because we will talk about these a lot during the whole course. I wasn't lying to you. Okay? It's very true. All comes back to those principles. So, the matching principle says we need to match expenses and revenues in the same accounting period. So when I sell that box of markers, right, say I sell for $3, I need to then debit cost of goods sold, credit merchandise inventory in the same accounting period that I made the sale of those box of markers per the matching principle. Okay? So what I'm saying over here is when all the units are purchased at the same cost, if they were all purchased at the same cost, all purchased at $1, then it doesn't really matter, right? Because then you just debit cost of goods sold, credit merchandise inventory for $1. But the problem is, and we just saw that in that example, that may not be true. Why isn't that true? Why would we have different costs for the same box of markers? Well, different suppliers. You know, maybe one company says, well, we raised our prices. Maybe inflation over time. Okay? So there are various reasons, such as switching suppliers, different suppliers, inflation, or even deflation, that cause prices to rise or fall. Okay, and so we can't assume this, that we purchased everything at the same cost. That's just not going to be true. Okay, this is not going to be true. So we have a couple different methods as I was going over. We have specific identification, first in, first out, last in, first out, and weighted average. And again, these are the methods that we will use to help us figure out what our cost of goods sold is and what the cost of ending inventory is. Okay? So let's walk through an example of specific identification. All right. So here's some information about our mountain bike inventory of trekking for the month of August. I'm at the top of page 120. So it says August 1st, beginning inventory. We have 10 bikes that we purchased for $91 a bike. So that means our inventory cost is 10 times the 91, 910. And then we have our units inventory, 10 units. On August 3rd, we purchased another 15 units at $106 each for $15.90. On August 14th, we sold 20 bikes at $130. Okay, that's the price. This is the price over here, this 106 on the 3rd, that's the cost. But on the 14th, we sold the 20 bikes at $130, that's the price. On the 17th, we purchased another 20 bikes at $115 cost, $2,300. And on the 28th, we purchased another 10 bikes at $119 a bike, $1,190. And on the 31st, we made a sale, 23 bikes at $150 each per bike. That's the price. Okay. Now, a specific identification, and I think what I'm going to do is I'm just going to give you an overview, then I'm going to stop the video and then in the next video go through the working example, okay? With specific identification, what we're saying over here is that we can identify the exact item that we sold. We can identify the exact item that we sold. And so what that means is we know the exact cost of this item that we sold. So if somehow we were able to tag all those boxes of markers and say, we sold this box of markers that cost us $1, we could use specific identification. The problem is that's not very practical for high volume products. It is practical for companies with very expensive custom-made inventory, such as a car dealership. Okay, a car dealership, they would know that. So a car dealership would be a good company, a good example of a company that would be using specific identification. So think big dollar inventory, low volume, big dollar inventory. It's custom made and they can figure it out. They can say, this is the exact cost. High volume inventory, no, not practical because of limitations in the information system. Okay. So in the next lecture video, we're going to go through this working example with specific identification and then also talk about first in, first out. Okay. Thanks.